And Eric, I know that today you want to tackle the topic of fees relative to ETFs. And I have to tell you, so I worked on the asset management side for a number of years, spent a little time with an investment advisory firm. The constant pressure was the fact that these ETFs, the fees are so tiny. So some of the smarter potential clients, they would always talk about, why are we going to pay you? Is this the great cost migration that you have been writing about?
Yeah, so the great cost migration, which is my big fancy term for this downward pressure on fees and funds. We have seen ETFs and index funds drive down fees consistently, and it's being driven by advisors. They are the ones who are mostly driving this cost migration. They just want the cheapest possible products because now they're fee-based. They're not getting commissions. So it's in their interest to go to the cheapest fund. So there you have a chart showing that 90% of all the flows into passive, that's $700 billion, are going into products that charge less than 20 basis points. Well, this is obviously hurting asset managers. They don't know what they're going to do in the future if they have no money. So what they're saying is, hey, advisors, you're still charging 1%. You haven't had to take anything on the chin with this cost migration. We're actually going to start offering advice. So the asset managers like Vanguard and Schwab, who offer those low-cost products, are now going to offer advice and compete directly with their own clients in an effort to lower fees. And they're charging 30 basis points, 25 basis points, similar to what robos charge, for human advice. And this is going to be very compelling to advisors who currently charge, 1%, 1.5%.
Well, speaking of robo-advisors, pretty interesting there. But I know that your work is more focused on Vanguard, a beast of its own making. Why are you so interested in Vanguard?
Yeah, so the robos are definitely hot, and they're going to have an effect. But Vanguard, again, they have something special. No profit motive. Vanguard has a mutual ownership structure, and that is, nobody else has that. They're playing a different game. They are not looking for profits. They are looking to gather assets, and any profits they get, they lower fees. So even this advice service they come out with, those are some of the ways that they have this clear message that way they can provide advisor alpha of 3% a year using behavioral coaching, rebalancing, et cetera. And that 3%, you could argue, is the new active management. The advisor will deliver you 3% in alpha and then use passive products. So it's shifting from picking stocks and bonds to delivering alpha by the advisor. So it's a compelling message for a cheap cost, and that mutual ownership structure, they'll continue to probably lower fees even below the 30 basis points.